Financial planning is a skill that every person should possess. Setting investing goals may seem simple, but when it comes to following through, many of us struggle because we don't know where to begin or what the best course of action is. It all begins with understanding what is truly important in your goals. If you are interested in learning more, stay tuned. Number 1, know what is important to you. Knowing your objectives is crucial before you begin investing. If you want to buy a house in the next year, pay off your student loans, save for retirement, or do something else along similar lines, focus first on saving money for that before investing it. Determine your financial objectives and whether investing fits within them by using the acronym SMART. Your objectives should be specific, measurable, achievable, realistic, and time-based. Number 2, your goals should be grouped according to how long they will take to accomplish. With your goals defined and knowing how long each one will take thanks to the SMART technique, you should now divide them into 3 categories: short-term, medium-term, and long-term. Most short-term goals can be accomplished in a year at most, and they often don't cost much money. The medium-term goals can be beginning a new career path, starting a new business, learning a new skill, or getting a new job. These objectives are more time and money consuming to complete than short-term goals. Long-term goals make up the 4th group, which is what most people think of when we discuss investments. Typically, the majority of us would consider retiring, setting aside money for a child's college, or taking the reins as our own boss. Long-term goals typically require years to complete, but with the correct saving strategy, they can be completed quickly. Number 3, invest in things that will help you achieve your goals. Now that you have short-term goals, you must choose the best investment strategy. Either use money market funds or high-earning savings accounts. Since the interest rates on these accounts are typically not very high, you won't be making much more money, but at least you'll always have access to your money. These accounts have relatively minimal investment risks, making them ideal for objectives that will be completed in a year or less. You might alternatively decide to put your money in a savings account, but be aware that it won't grow there. Depending on your total risk tolerance, you may want to consider taking higher risks while investing in medium-term goals, which might take 5 years or longer. You may use an exchange-traded fund or ETF to allocate tiny sums of money from your portfolio to a high-quality stock if you want to get superior results. Since the high-quality stock can occasionally lose value, this would typically be best suited for those with a high risk tolerance. You might check at money market funds or high-return savings accounts if you don't have much to risk. A different strategy is required for a long-term goal, like retirement, because of the fact that these objectives typically provide plenty of time to make up for any losses accumulated over the years. The main justification for using stocks in your investments is this. Stock investing is as simple as it sounds, and you may utilize an internet broker to complete the task. I would suggest diversifying your investments so that not all of your money is lost if one investment fails. Through mutual funds or exchange-traded funds, you can also invest in a selection of companies. However, you should proceed with caution since you might end up paying fees that are excessive for the investment. Using target date funds, which are ideal for retirement investments or college fund savings, is a simpler method to go about it. On the labels of these funds, the year the goal is projected to be accomplished is typically indicated, and those funds are then invested with just that time frame in mind. Number 4, think about how much risk you're willing to take. Your investment plans will often either change for the better or worse, based on how risk tolerant you are. Therefore, you should think about how much risk you'll be taking as well as the bills you need to pay for yourself before making any investments.
Let me know in the comments if you have any other questions about investing. Let's return to the video.
When you still have kids to care for and have expenses like housing bills, meals, and repairs to pay, you would still not want to have a very high risk at all. The greatest strategy to reduce your risks in half is to never risk more than 4 or 5% of your whole portfolio. For example, if you risk 4% of a $10,000 portfolio, your maximum potential loss is $2,500 on each investment. Number 5, build a diversified portfolio by mixing things up. Never lay all of your eggs in one basket is a phrase that everyone is familiar with. Investing in specific sectors can occasionally yield highly promising results, but it's never a smart idea to put all of your money into one place, no matter how great of results you're hoping for. The key is to invest in a varied portfolio because things don't always go as expected. The economy, interest rates, politics, and even the weather may affect an investment. By spreading your money over several sectors, you can ensure that while one area falters, another will continue to thrive. One of the best ways to protect against the market's ups and downs is to create a balanced, diversified investment portfolio. Number 6, put up a workflow for investments. One of the best strategies to succeed in investing is to make a plan of action. Before you reach this stage, you simply have knowledge of what matters to you and you have already classified your goals according to their completion date. This specifies your procedure for saving and investing, which will be more difficult to follow without clear goals and objectives. Everyone has unique circumstances, including various living expenses, various family situations, and various retirement needs, which is an important lesson to take away from the discussion of the investment workflow. Before selecting what will work best for you, you'll need to evaluate your own situation utilizing a variety of pieces of information. A flexible and adaptable plan would normally be one that has to be adjusted significantly or totally. Number 7, identify your investment budget. Sometimes you have a tendency to go right into work without first determining how much we'll need to put into what. I get that it's simpler to go without taking the cost into account in order to reduce stress, but knowing the precise amount to invest should always come first. You may compute how much you'll have to save annually to reach your retirement financial goals by figuring out when you'll need the money. The answer is often as much as is practical, but for more specific objectives like budgeting for your child's schooling, you can reverse engineer the amount you need to save whether you start saving at the time of the child's birth or another year in the future. It does not matter when you start saving, but the important thing is that you'll be ahead of the game when you know how much to invest in the time you have. Number 8, consistently make gold check-ins investments. After completing all of that and beginning your investing, you must now ensure that you routinely review your investment goals so that you are aware of your progress. Goals can vary from time to time, which is why you should review them and make any required adjustments. As time goes on, medium-term and long-term goals generally turn into short-term objectives, so when this happens, you should re-evaluate your investment approach. If we're being honest, what good is having all of your money invested in stocks if you still have a year left before retiring? You'll have your portfolio in order because you'll be modifying it as needed if you conduct regular check-ins on your goals. The first step in attaining your investment goals is always to be aware of them. To accomplish this, carefully consider what your short, medium, and long-term goals should look like. Then start investing according to the time frame. Don't forget to estimate the costs associated with each goal so that you are never caught off guard. If you exercise good self-control and stick to your financial strategy, I believe your journey will go smoothly. I won't promise that the road will be smooth. It will undoubtedly be rocky. But if you take the steps I've laid out for you and have a clear vision, you'll be an investing pro in no time.
Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching! Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.